Today we are all about that homework life. I have no slides prepared. Everything is going to be student presenting. But before we get to that point, I need to go close SGOV. Now, SGOV is going to be rolling over tomorrow. How do we know this? Because you can go look at what the ex-dividend date will be. And on that date, it drops by the amount of the dividend. So all we have to do is get out, watch it drop down. The dividend will pay in a couple days, and then get back in. Now, one of the reasons we do this, and every month, not everybody, but every month, there's a new person who's asking, well, why do we do this? The reason being is that, and in fact, I learned this from an alpha student, by the way, Dave. Hope Dave's doing well. But every month, you'll see SGOV go up, and then it resets down. This distance right here, which I can do shift-click and push down, is the amount of the dividend. So 33 cents in this case at the end of October. And then at the end of November, shift down again, 29 cents. Okay. So that was the dividend. Now, it takes a couple days for that to show up in your account. And this is what happens on every stock that pays a dividend. There's nothing special about SGOV in that way. But what's special about SGOV is that it's basically daily paying you interest, and you can get out and get right back in. Now, the advantage to getting out and getting back in is you actually get to earn more interest here, right? If it takes 3, 5, or whatever trading days for that those funds to get back into your account, and then you go buy more shares, you can actually make 1, 2, 3, 4, 5 days worth of interest in the meantime on what's being deposited in your account. It's actually a nice little hack. And for what is the word? Wash sale rules. In case any of you ever have to deal with a wash sale, you have to deal with wash sales if you take a loss on a trade. But if you take a gain on the trade, the government's like, cool, don't worry, you're going to pay us taxes anyway. But if there's a wash sale rule, cool, you're going to pay us more taxes anyway. They're trying to get around it both ways, okay? So you can avoid any sort of wash sale rule by getting out, because you know what's going to happen. It's going to roll over on the last day of the month. Instead of, let's say you got in right here, you watched it go all the way up, and then you need to sell out here to go put on trades, okay? And then you get back in here. Now you've got a wash sale that you got to deal with. You don't have to deal with that. You don't have to deal with that because you took a small loss here and then you got right back in. You don't have to deal with that because you're always getting out at the top. This is the one stock where you can actually get in at the bottom and get out at the top. And it's very predictable. And this one time a year, does it reset at the end of December and then go up all of January. So there you go. There you go. Batman always pays his taxes. All right. That is the rule for Batman. Batman always pays his taxes. Batman avoids jail time. Yeah, there's no way. So that is what I need to do. I've already done it in my personal account. So let's go do it in the Outlier Fund account, which, oh, snap. What a beautiful 3 months. And even with a couple trades that look like they're losing right here, this is actually after we've rolled. They are still big, beautiful winners. And that's why you add all of it together. And holy moly, what is it like to have the outlier effect in your account kind of thing, right? This is what it looks like. Oh, man, how crazy is that? So this is what it's going to look like all of next year while we run this through the U.S. Investing Championship. In fact, I was talking to my family yesterday. I was like, I probably will do this forever. I don't see any reason why I wouldn't compete every year. Like, this is my jam. So we are closing SGOV. All you got to do is send to ticket. Now we're closing the options here. So we have, or not options, the equity, the shares. So in this case, all we're going to do is we're going to take 743 shares. We're not going to get filled at 157. Let's go down 156, hit the sell button. And you'll see right here, it's filled already at 156. So I'm now out of that. It takes a couple minutes, I've noticed, for it to update over here. Almost right away. Option buying power now, about $75,000 in this account. So we're good to go. Too easy. So we're out of SGOV. Let's take a very quick look at the trades that I have on. These are the exit signals I'm going to very quickly look for. I'm going to hit the outlier button on my Stream Deck. Boom. Man, the Stream Deck is so sick. I love it so much. We can see over here, no sell signals. So done there. like it's really fun for you guys to watch, because when you have a plan, you just go boom, 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 boom. Discipline equals freedom, right? That is a Jocko Willenick quote. He wrote a whole book about it. But basically, it's have a plan, execute the plan. Then you don't have to think about it. Your mind is free to do anything. So I don't have to worry about that. 1020 bearish cross. Let's go take a look. The 3 trades that we have on right now, SYF, still looking big and beautiful and a bullish trend. 10 is still over the 20. HTGC, 10 is still over the 20. And LC, the one that I think a lot of people were starting to doubt, up nearly 7% today. Big, beautiful, giant up move. That's what we're looking for. And I've already rolled it 3 times, so I have practically no risk in the trade. So we don't have any of these hitting. They do have a couple order blocks that are built, but none of them are 120 calendar days, so we can ignore them. None of them have earnings. None of them have gapped and crapped. Now, hear me out. This is a big, beautiful candle. This is not a gap. A gap is like this area right here. So let's focus in here. A gap is close to close. Okay, so in this case, remove. If I go shift click, that was one of the best things I learned in yesterday is how to use TradingView video. 4.36%. So that wouldn't even count as a gap and crap situation because we back tested it and we found 5% to be that gap. And we tested 1, 2, 3, 4, 5. We tested all the way to 10 to find that point. None of them are hitting any of our stop exits. So I don't do anything other than close SGOV, which I've already done. Now I get to make a big announcement. I don't know if you guys have heard it on the Discord, but a big announcement is being dropped. And let me go over to the general chat. Here we go. Big announcement is we have partnered with a 10-time Emmy award-winning journalist, Vida. She is going to be joining our team starting in January. I am so stoked about Vida being a part of our team. She is going to be on Team Outlier. Vida is a television host, broadcast journalist, and DIY expert with more than 2 decades of experience in local and national TV. As a 10-time Emmy award-winning journalist for hosting, reporting, writing, and producing, she has appeared on the Today Show, CNN, lots of NBC, ABC, and CBS affiliates. She has a YouTube channel with over 100,000 subscribers. She'll be helping us create all kinds of more content geared specifically for the female demographic. And it is pronounced Vida, not Vida. Just so everybody knows. Vida, like video, is what she told me. So this is going to be huge. I am so stoked. So you guys go say hi to Vida. Let her know how excited you are because she is going to basically be the female face of Outlier. This is going to be amazing. So I know that this was a big deal for us with 91.3% of our audience being men. We're missing a huge portion of people who can also be outliers. And one thing that she said is, listen, Chris, you got great stuff, but you go so fast. I can't follow this. So what I'm going to do is I'm going to do one-on-ones with Vida, like literally one-on-ones. Everybody's going to be able to watch these one-on-ones. I'm going to teach her everything that I know, kind of like we're doing in Outlier University. And then Vida's going to take it. She's going to modify it. She's going to create her own trading plan. And she's going to have Plan Vida, and she's going to run that, and it's going to be amazing. She's also going to help us with news. As you guys know, I am not a news junkie, but Vida is a news junkie, and we can use that and come up with amazing content. So I am super duper stoked about Vida being a part of the team. Yeah, this is going to be awesome. So with all of that being said, the plan for today is listening to you guys. Stocky Locky, I'm not going to make you present while you're driving down the road. You're already being dangerous AF over there. I'm not going to make you do anything else, my friend. But let's start with Charlotte. Is your mic working yet? Did we get that fixed? Let's double check. No, it's not working yet. Yeah, it doesn't show muted on my side, so it's got to be probably a connection or something issue on your side. Don't worry, we'll come back to you. No stress. Let's look at Boston Mark. Mark, you ready?
Oh, sure. Let's rip it
Listen,
apart. Let's
this
go.
is the first one I pulled up on my screen. Didn't you go the other day too?
Yeah.
Oh,
No,
no,
well,
we'll come back to you. You've already gone. You've already gone. No extra credit for you. Carol went the other day. Carol, did you go the other day? I forget. No. Okay, we're going to go to Carol's XLE. I'm more interested in this. Sorry, Mark. There we go. Carol, lead me through this. So Carol's got everything on one sheet. I like it.
Yeah. Sorry, Mark. Didn't mean to steal your thunder here.
Listen, if we
I
got
took a
time, we'll
look
come back to them. We'll come back to them if we got time.
Because it sounded like you had some updates. One of the things I looked at was XLE, just based upon your Chris's your Discord comments about what you found with USO, etc. So I was in the process of looking at how do you find out the optimization, if you will, without sub-optimizing, but which sector. Looking at each sector and how they perform against each other in the overall Plan M. So what I did was I just started out with basic setup of 10 over 20 over 50 EMA. Those were my entry points. And I went back 5 years and I took every trade. I did everything manual. So I took every trade regardless of whether or not, assuming I couldn't see the future, but if it was crossing over the 10 EMA and the 10 was over the 20 over the 50, then I took it. And then I went to see how many days that trade would last before it tipped over. I did use an exit where it crossed below 10 EMA. And what I found is that the majority of the time that was effective, because once it tipped over, it kept going. There was probably about 5 or 6 occurrences where it didn't tip over to the 20 EMA and it actually came back up. And I figured, well, if I was actually trading it, I would get back in with an alert saying it came back up. But anyway, so that was just those 2 basic parameters. And then as I took all those trades, then I collected all the data. So I looked at, captured whether it was a buy or sell in Outlier, what the fear and greed was, just going through all the parameters. And I collected all that information and basically, started to distinguish how the outcome was, which, as you can see, the expectancy on my original sheet, I had the wrong formula for expectancy, but I the trick about doing the average of the profit percent.
So easy.
It was about 4.7%, actually rounded up to 5% as an expectancy. And the average days held were 11.3. And that was all the trades. But the best winners were where I've got greater than 11 days, where I had the biggest bang for the buck. And then, and I also broke out value zone. So you can see that in the lower right. I'll kind of go from the bottom up. So the trades, if I held it between 1 and 10 days, and that I had 4 wins and 14 losses. And what I found is, going back, that the EMAs were converging on each other. And so the next trade I took, it was in there for a really short period and lost. And then I looked at value zone to see, okay, was it in the value zone or not? And so there were 2 that weren't in the value zone. They were actually above the 2 ATR that I entered. And those ended up being losses, actually immediately tipped over. But once it was in the value zone, that's where it's I've got more stability on my wins. And then I looked at, go ahead, sorry. Did you ask?
I'm just nodding my head. I'm finding some interesting things here. A couple observations, right?
Yeah.
If it's a short-term trade, you want it to be a loss, right? You don't want to hold on to this thing for 6 weeks just to find out it's going to be a loser, right? But a lot of people do that. Super common. What you found was actually losers, you want to be super short-term, and winners, you can let them run for as long as they take, right?
Right.
Makes it so much easier. Yeah.
Right.
And then over here, I find this interesting, right? Now, granted, it was above the 2 ATR point, but you only had two instances. So it may be possible that it is a good entry, but when it's only 2, it's tough to say. So I wouldn't rule that out just yet. Maybe more back testing there, but the value zone actually looks like a very statistical, what am I trying to say here? A very relevant observation right here. When you've got nearly twice as many wins as losses, I think that's pretty important right there. So keep going. This is great.
Okay. And then the outlier blocks. So the no represents that it wasn't greater than 2% away. So that even though I entered it, right? So I was just looking at the EMAs as my entry point. And so I came back and looked at the outlier blocks to say, okay, if there was an outlier block, how'd the trade turn out, and the majority of them were losses because outlier blocks work.
Wait. Are you telling me these random spots on the chart that absolutely can't have any possible significance whatsoever just happen to be points where the stock price goes back down randomly? Is that what you're telling me?
That's what I'm telling you.
That's so crazy.
That is crazy. And then on the signal, for the outlier signal, the buy versus sell, that was kind of a mixed bag on the buys. But when I look at all the data, if I start to filter down on the signal with the outlier blocks, the value zone, and the length of the trade, and fear and greed, it all basically came down to follow the outlier plan because it works. And so you get a higher percentage of wins as a result. So there you have it. You're just trying
to get extra credit. You're trying to butter up the teacher right before Christmas break. I see what you're doing here.
No, I just had to prove it to myself,
But now that you've proven it to yourself, doesn't it make all the more sense in the world?
It does. And I first learned about backtesting when I first started trading, right? But there wasn't a strong emphasis in the class I took. And dang it, I wish I would have done this way back when.
Oh, that's exciting. Keep going.
Well, it really pinpointed a lot of things. And it just, you start to open up your eyes to say, oh my gosh, wow, that really is impactful. So anyway, looking in that middle table, like I said, I did 5 years of trades. Average held was 11.3. So that was right in the middle. Total trades I did was 38. The number of trading days was 428 in the data. Number of wins was 23, and the number of losses was 15. So, kind of a mix there between 30, 40 to 60% ish. But the expectancy was pretty decent at 4.7. Rounded up to 5%.
That's great expectancy.
Yeah. And then I just, on the general conditions and the losses and double-digit wins, I started to accumulate, what the data was telling me, why the losses were occurring. Again, that outlier block was a big one. And then the two, I know it wasn't totally relevant, but there were two trades that were above the 10 EMA. It was like that single day where it shot up and it went above the 2 ATR. And so I entered per the plan for my, entry criteria. And then it immediately tipped over. And then the double digit wins was really proving out the outlier entry points.
So, go ahead.
One thing I do want to highlight is I didn't close on a green bar day, even though it went through the 10 EMA. Oh. So I said, I'm going to trade at the end of the day. And by the end of the day, it would be back above the 10 EMA. Mm-hmm. And then I also didn't close if wicks were hitting it. So if it was a red bar and the lower wick went down, and by the end of the day, it came back up. So those were two key points. I didn't try to review it during the middle of the day like I typically did as a day trader, where I'd always be on and watch that and immediately take action. So as the end of the day was key.
Well, I think that right there alone is a really interesting observation, because I am not one to say that trading at the end of the day is the best way to trade. But if you're running these back tests and stuff, you're not going to be able to see in that bar what the price was at 11:43. You're not going to be able to see what the price was at 9:37. Exactly, open, low, close, high. That's it, right? So if you're building a trading plan, you got to be able to build to the data you can see. And it's pretty interesting that it proved out there to actually be beneficial as well. But I wanted to ask, because this reminds me of what we talked about with Rick in the last class, which is have an idea that works on, just test an idea. Then test another idea. Add those two together. How did that perform? Take another idea. See if that works on its own. See if that works in a vacuum. Add it to the others. See if it works together. If it improves the expectancy overall. Is that what you were doing? You were taking it piece by piece and then adding more to it as you went?
Well, actually, no. What I did the trades I took were specific to the one entry setup, which is the 10 over 20 over 50. And the exit I took was the cross below the 10 EMA. But when I was looking through the trade, as I went as I was looking at the daily bars, and if it crossed below the 10 EMA, you could see, because it was the day bar, you'd see it, the lower wick, right, where it went down and then it came back up. And so it was a confirmation. So I just added that in the table as I was reviewing all those elements. But I entered the trade and exited specific to those two terms. Does that make sense?
Yeah, it makes sense. Yeah. But one thing you also put on here, which I really like, and we've discussed this before, is find the characteristics of those winning trades and the characteristics of those losing trades, and then make sure that you don't do more of what's working and less of what's not working. You even wrote it out right here. So I think that's brilliant, right? That's exactly what you need to do. Take those observations, treat it as if this is a crime scene, and you're going through objectively looking for A, B, and C, looking for all the different clues that you can come up with. Carol, this is great. And especially coming up with that 5% expectancy, that's huge. Well done to you. I'm really proud of you. Everybody give Carol a golf clap. She deserves it. This is outstanding. I love it. Way to go, Carol. A+, and A+ for saying that the outlier plan works. Double A+. In fact, I'll definitely give you a little bit of extra credit for that. Shane, I know you're somewhere in the Outback. Are you willing to go over yours?
Yeah, we can it's just really crude. So you have to bear with me.
Let's see. This is it, right?
Yeah, that's it. Yeah.
Okay.
It was a little bit more fancier and had a lot more data and like dates and stuff like that lined up. But anyways, my apologies for this, the crudeness on this one. But what I did back testing in is kind of like with you and outlier blocks. I am that believer in trend lines, just because granted I've only been trading almost 3 years now, but when they work great, and they don't work with every stock, and sometimes they work with stocks for a while and then they just stop working altogether. But the stocks that I have really been watching because they have been working out great over the past few years or since I got in trading was AMD. AMD has probably been the most solid one. And then with Amazon. And I have it broken down into kind of 3 different trend lines to follow. A long-term one, which is typically over a couple years. With the back testing I was doing is with the long-term trend lines, they're like put down at the bottom. I think it was like in the high 90% where their win rate, where if you take right there. Oh no, this is the
Sorry, I'm doing my best here.
You're fine. Don't worry about it. Well, it's all the way down the bottom.
All the way down at the bottom.
Yeah, right there. I'm sorry, 62% win rate. If you follow the long-term trend lines, that's if I am going with the buy and sell signals with outlier.
Okay.
If I follow that, it's a 62% win rate with an average of 6.7 gains. In the other one I had, if I just follow the trend lines or the long-term trend lines, the win rate was it was in the low 90s where you would win.
Wow.
But it was you were only doing like 1 or 2 of those trades a year. That was the biggest downside, is you had to sit there and wait for it to hit that long-term trend line. Over the course of the 3 years that I was trading, where I actually got into those trades with the 3 different stocks, it was 5 times. That's it on the long-term trend lines. But when they hit, they were really good.
Shane, let me interrupt you real quick if you don't mind. Sorry. When you're talking about long-term, midterm, and short-term,
yep.
Are you saying that these are like rays drawn on the chart?
Yeah,
So
if
let me
you
go to
the dates that I actually have on there and the slide that I had, it had the pictures of it. If you go
That's
to
okay.
trading view, and then the long-term trend, like on November 30th, 2021.
Okay, let me go to that real quick.
Yeah, you
Teach me your
gotta.
ways, Shane. That's what I want you to do right now. Okay. November 2021. Okay, here we are. So the beginning was November 30th. Is that correct? So like
Yep.
this
Like, I can bring it up myself.
here. Okay. And
So
then
you're an AMD, correct?
yeah, AMD, the Advanced Money Destroyer.
Exactly.
Until
And
March 7th of 2024. So you're connecting 2 points across 3 years. Am I correct?
Yes, November 30th, 2021. You can put the line up there and connect it to March 8th of 2024.
Okay, so from here, this point to this point, correct?
Yep. And if you just continue that line straight on, it's going to
like this?
just right there. And then go over and you'll see it like actually, or just move the whole thing over and see it touches that right there. This is one of the trades I got into just a little bit ago on when was it? October 30th is when it bounced off that trend line.
Are you saying you're going short AMD?
Yes.
Okay. I was like, I'm missing something here.
No.
All right.
But that's the long-term trend line. With those, the accuracy of those ones are very accurate, very reliable. The shorter term ones that you get, the midterm, which is usually monthly-ish, around in a month, or a few months or so within a year, they're not as reliable, but they're still decent. And the big thing I've noticed with those is if they break the trend line, they typically don't break no more than 5%. So if it goes below the trend line at 5% or above, depending on which end you're looking at, that typically means it's breaking that trend line. And when it does, it usually runs pretty good.
Okay, so what you're saying here is if it goes over by less than 5%, then look for the reversal. Is that what you're saying?
Yes, correct.
Okay.
As you can see there, it hit the trend line and it went above it. But then, it went back down a little bit and tested it again.
Yeah.
And it's, you worded it perfectly when you say, you might win a buck, you might, lose a buck here and there. But, with this, on AMD, there's another midterm trend line that it's bouncing off of right now. And if it goes down 5%, or I had it worked out like another 2%.
Probably right there. That's probably what you're talking about. Okay.
Yeah, it's on it right. Yeah, exactly. I'm keeping an eye on that to determine if I'm gonna get into that trade too, because it's heading south and there's a bottom long-term trend line that AMD has formed, and it's on trend right now to hit that. And if that goes down, I don't remember if I hit if I put the projected percentage gains. I don't think I did on that. No, I didn't. Sorry.
That's okay. So let me ask some follow-up questions on this.
Absolutely.
How do we determine these tops? So, for example, it looks like you're clipping tops here. Yep. Would you also clip tops like this? Or no?
Yeah. What I do is through this stock, I'll have a bunch of different long-term, midterm trend lines. And if they are going through and they stay steady, I just keep them on there, and they'll bounce off them. And if they break through that trend line in one way or the other, I just delete it. Then typically that means that trend line's no longer valid.
Yeah.
That one there that you're kind of developing.
Yeah.
That one when it passed through that trend line, I got in there and once again, I have to go back and check my actual wins, but that was like a huge, one of my biggest trades is when it broke that downwards trend line and it started going up and it just started running. And that's where where you started to show how to roll calls and stuff like that. And I was like, oh my gosh, this is like a ninja move, as you said. When I first started rolling calls as they went up, because I rolled it at least 4 times, if not 5 times this call. So by the time I ended up exiting it, it was, I was risk free at that point.
How many Lambos did you get?
I'm in the process of purchasing my 3rd one. You guys need to help me discuss which wrap I should put on it.
Oh, I love it. Very good. Very good. Well, Shane, this is interesting, right? This is a different approach. And I am not going to say one approach is better than the other. I like several things here that you've come up with your plan that fits your personality, and that you've got specific dates for what you're looking at right here, right? And so the objective here was to do the back testing. And so that's what you've done as well. You've done the back testing on AMD, on Amazon, on SPY. And then he's also got some other trades that he's got over here.
With that, those are the trades that with your trading plan, it either I utilize the trend lines, because not every single one of my trades I use trend lines. Those are just one of another criteria that I use to determine if I'm going to get in or out. In a couple of your trades, I looked at and I either didn't get in them because they were working off a trend line or around a trend line. So I either didn't take it, or I exited a few days before you did. In a couple of them, I stayed in because I'm like, well, they're bouncing off a trend line, so I'm not going to exit. And there was 2 of them. One of them, it continued to go up a little bit, and the other one, it took a crap, and I ended up losing, a little bit more money if than I would have if I would have got out, with your sell signals. So it just really hits home when you said it, is developing a trading plan that, works for you. And
exactly.
For me, I like this. I like the trend lines. They've been reliable for me.
Well, and that's the thing too, is that you have to like it, right?
Exactly. Yep.
If you don't like it, you're not going to do it. You're going to fight it, right? It's like,
Yep.
Shane, what's your least favorite restaurant?
Ooh, man, I don't know. I like a lot. Red Lobster.
Red Lobster. All right. So let's say Shane's wife was like, oh, Shane, I really want some Red Lobster tonight. He's like, gross. No, thanks. I am not going there. We'll go there, but the only thing I'm going to eat are the Cheddar Bay biscuits. The rest of it can go in the garbage. All right. I'm not going to eat any of it. That's the way I am with McDonald's. My family will be like, I mean, yeah, it's a McDonald's. I'm like, well, you go get your McDonald's and I will not eat tonight. That's fine with me. Yeah. I will not do that. So I get it. And because of that, like, let's translate that to trading, right? If you don't like it, you're not going to eat it. If you don't like the plan, you're not going to trade it, right?
Yeah, so it is. You're going to look
where he's going here. Yeah,
you're going to look for ways for it not to work. That's the best I can relate it.
Oh yeah. And I also want to point out, Shane is not a SoFi bro. Shane, and that's why I highlighted this. I want everybody in the comments to make sure that you understand that Shane is not a SoFi bro. So all those nasty, dirty, ugly comments need to go to Shane, because it's his fault SoFi went down. He made you sell your SoFi shares. He's the one who bought the puts. Stop putting the blame on Chris. Chris did not make you sell your SoFi shares. It was Shane.
You want me to add on to that? SoFi just broke a pretty big trend line, and I just bought put options on them yesterday. So
okay. All right, teach me, because the haters just came out, Shane. They're leaving all the nasty comments. They're like, that stupid son bitch Shane, that's all his fault that it's going down. He bought so many puts, the market makers are going out there and selling off the stock.
Exactly.
Bro. Shane monkey hammered SoFi. It's all Shane's fault. Okay, Shane.
Only if I had the capital to do that. That'd be awesome.
Take that Lambo money and show us how it's done, Shane. Right here. So seriously though, show me how you would have drawn your trend lines on SoFi.
Oh yeah. Go to April 7th of 2025.
Okay.
And then connect
Oh,
it
I gotta
to
go back. Hang on.
yeah, it's a little bit
April
back.
7.
And this is what I would consider a midterm trend line.
Okay, so we got April 7 to where?
Well, I got a whole bunch of things on here. I'm trying to unmark them. Then connect it to May 30th, 2025.
Oh, okay, May 30th. Am I connecting the tops or the bottoms?
I'm sorry, the bottoms. Sorry, the bottoms.
Okay, so the bottom here to the bottom here. Got it. All right.
And just have the line continuing like that.
I know. I understand the assignment.
Gotcha. Yep, that's roughly it. We see there, it broke through. And when it broke through, it broke through big. It gapped down.
It broke through bigly, in Shane's own words.
Bigly.
You've been warned. SoFi
and it made that it broke that 5% mark. So I'm like, I'm in.
He's in. He's in, ready to take your money if you still own SoFi, because it's going down like this. That is Shane's evil, dark, horrible, no good, very bad plan. Shane, I love it.
It gapped back up, and then everybody's like, "Stupid Shane."
Stupid Shane. This is all your fault.
Hey, but this is my
SoFi
plan.
bros are real.
My plan, it works for me.
Brandon says, I'm all in SoFi. Okay, Nate actually has a good question. I was wondering the same thing. Thank you, Nate, for asking the question. Where's your exit point?
My exit points are a multitude of things. If it breaks another trend line, because a lot of times with trend lines is they'll kind of get in a channel and they'll bounce off the top of the channels. And when it gets to the top of the channel, I'll exit, or if it gets to the bottom of the channel, it really depends. And now what I'm kind of shifting to is I'll get in the trade, and then I actually use Outlier to tell me when to get out of the trades. So if I'm SoFi is in a sell on Outlier, if it turns to buy, then I just exit the trade at this point, unless it's bouncing off a trend line and stuff like that. I'll give it a little bit of wiggle room there.
Hang on, let's go double check SoFi real quick. I had to hit my stream deck button. I need to save SoFi as a favorite. Hang on, let's go save it as a favorite because it's the greatest stock of all time.
Oh, then you're probably super stoked I brought this up, huh?
I am. Well, SoFi gets the engagement. SoFi bros are so obnoxious about the stock. It's pretty embarrassing in my opinion. Oh, Chris said it's embarrassing. I'm gonna leave him an ugly comment. Go ahead. I ain't gonna read it anyway. All right, look at this. So, you got that sell signal, right? It's getting more fearful while the whole sector is getting more greedy. I find that interesting, right? People are abandoning SoFi. SoFi may not be going to the moon. So, yeah, I've saved that as a favorite. So now we can always check in on the world's greatest stock, SoFi, because Shane thinks it's going to zero. Shane is not one of the SoFi bros. The SoFi bros will not unite. Wait, did somebody say, pro tip, save SoFi?
Pro tip.
There you go. Exactly. Pro tip. So well done, Shane. I think you did great. I'm excited because your strategy is very different than mine. And I love that. I think that is brilliant. I will never tell you to do exactly what I do. So continue doing what you're doing and make that money, my friend. Make that money. Let's see. Okay, let's see who else we got. So again, wait a minute. We didn't give Shane a golf clap. Shane's a SoFi hater though. So should we give him a golf clap? I suppose. I
hate all stocks.
All stocks are bad? Is that what you mean? Very cool. Okay. Let's see. Charlotte, have we got your mic working yet? Can we try a little mic test?
No, testing.
Go! We're back in.
Hey,
awesome.
Damn.
Very cool.
Happy Christmas, by the way.
Hey, happy Christmas to you. All right.
My plan is only 90% done.
That's okay.
So I need a little bit of help. I
let's do this.
uploaded the Excel sheet if that helps you.
Well, let's start with what you have right now. We don't need the top up there. Okay. Tell me, walk through what you got.
Okay, so I'm in plan ETF at the moment because I've been away. And whilst I was away, I was trading plan. I was doing the TQQQ. But I noticed when I was away, I was using all the signals, putting them directly on the TQQQ. And one day I had a look at the QQQ and I realized I should have got out of my trade a couple of days prior.
Oh.
So my question was, does it really make a huge difference if I use the 10, 20, etc. on the TQQQ rather than on the QQQ? So
okay.
That's what I was back testing.
That is a great question. Now, the plan is actually built to where the plan is built for the signals on the Qs, which then gives you the option of either using Qs to trade with or TQQQ to trade with. So you can go with straight shares or you can use the leverage shares. But the idea is using the Qs as like your base, your starting point. And then if you, let's say, for example, if you were to go buy options on SoFi, right? Rather than buying the SoFi shares, you'd go buy calls on it. You wouldn't buy puts because you're not crazy like that guy Shane. You'd be going to buy, you'd be buying calls, right? So that's kind of the idea behind using Qs and TQs there. Does that make sense?
Yes.
Okay, cool. So when trading the Qs or TQs, does it make a difference if I trade the 1020 directly on the TQs rather than the 1020 on the Qs? Well, here's a great question, and I love that you phrase this as a question because all backtests eventually start as a question of how do I make more money, right? How do I make more money? So in this case, Charlotte has come up with her own theory and is testing that. And what I like about this is you're not trying to say, my theory is I'll make more money if I trade on the TQs. Your question here is not that. Your question is, does it make a difference? Right? Different phrasing here can lead to different behaviors as you're going through and back testing. So tell me more. You had a result there, I see.
I did, but that's kind of where I fell over a bit because one, I ran out of time, but I didn't really know how to quantify. Like I came up with a percentage difference and then I was done, and I didn't know if I needed to look at more stats or. Because I noticed when other people have theirs, they've got lots of things. Like they talk about the percentage gains, profits, and the percentage losses and stuff. So I didn't know if I only done half the job.
Okay. I actually love this question because at the end of the day, we're trying to boil down to one number. I mean, I don't care about all the other stats. I mean, legitimately, I don't care about when I go to my back testing data here. Here's all the data that you could want to know on Plan M, but I don't care about all of it. I care about one number, and that's expectancy. So at the end of the day, Charlotte, this is the number you're after. But
how do you calculate that?
Okay. So there's a long way, and then there's a way easier way. Okay. So the long way is, this is not a spreadsheet. Hold tight. I need to open a fresh spreadsheet here. Okay. The long way is your average win, like dollar or percent, doesn't matter, times, in fact, let's just do this, times your win rate. And then you subtract your average loss percent times your loss rate. Now, when you do that, that will give you mathematically your expectancy. That is the formula for expectancy. However, you can just literally take an average of all of the wins and all the losses, every one of them, but you have to do all of them, and it will give you the exact same result. So all you got to do, let's say you got 100 trades on a row, you just highlight it and get your average. That is the exact same number as your expectancy. Listen, I did this the hard way for 15 and a half years until Mark Gariski, our chief strategist, was like, why are you doing it that way? It's the same thing as just a pure average. And I was like, you've got to be freaking kidding. Are you serious? Yeah, there you go. The average of, not profits, the average of outcomes. The average of all the outcomes, meaning all the wins and all the losses together. So that's how you calculate expectancy. And honestly, that's the only number you need. But that's if you follow the plan precisely, right? So surely, Charlotte, when you're working on this plan, you're going to see some times where, you know what, I don't know if I really would have taken that trade. But if you're putting your biases on it, because you can see the future in this case, that's not an accurate backtest. And listen, I was guilty of it. I remember specifically going through backtest and all kinds of stuff. I remember one day sitting in this chair looking at that monitor, being like, "No, I wouldn't take that trade." And then I had a little realization. I'm like, "Wait a minute. I wouldn't know if this is going to be a winner or a loser. Like, that is an impossibility to know at that moment. So you know what? I really would have taken that trade." So you got to make sure that you can actually follow the rules for your setups here. So Charlotte, I mean, don't overthink it. Again, just hit that expectancy number, and that's really what you're looking for. But you've got total gains, you've got winning trades, losing trades, number of days in trades. You can calculate your expectancy. Here, let's do it together. So with Q's, your average win. Let's write this all out. Average win was, oh no, we don't have that number. You'll need to add those numbers. In fact, these are the 4 numbers you'll need to get: average win, win rate, average loss, loss rate. And then we'd be able to calculate, because I see number of winning trades, but I don't see how big those winning trades are. So you could calculate your win rate, which in this case would be a little bit less than 50%, but that's okay, right? It can be under 50% and have a tremendous return. And in fact, one other number you might be interested in is outcome. So when we have our expectancy here, right, which I just showed you how to calculate, you can take your expectancy, then multiply it by the number of trades. When you take your trade expectancy, multiply it by the number of trades, in theory, this would be what your portfolio would do, right? So for example, the expectancy on the energy sector is actually a bit lower than others at 550. Trying to show all of it at once. Here we go. But that doesn't mean that it's broken. It just doesn't have a lot of frequency. Because 274 is actually really good. It's one of the top ones. And then you can look at financials, has a lot of frequency and has a high expectancy. So it leads to a high outcome. So you're multiplying those two together to get your outcome. I think that's a really interesting number. In fact, you can take it one step further and go from, okay, if I only care about expectancy, maybe I could care about outcome, because if I only trade twice, that's a big deal. But if you're trading 10,000 times, also a big deal. You're not going to be able to trade 10,000 times, and you're probably going to get really bored, and no offense, but most people would screw up their account if they only trade twice ever. Right? So you got to find that balance, and that's where outcome can help you find that balance. Does that make sense?
It does. Thank you.
Cool. Yeah, absolutely. So Charlotte, keep working on that. I know you've got a lot going on right now, but do your best. And of course, feel free to reach out if I can help you out, or any of the other Bravos can help you out. And you certainly deserve a golf clap. Don't feel like you need to come up with any extra numbers. You find what you need to find and keep it going. Keep it going. Well done, Charlotte.
Thank you.
Okay, let me see. I've got some other of y'all's work. Who have I not called on? I don't think I've called on Art. Have I, Art? Have we gone over your plan yet? Is Santa real? This is a family show, Art. Speaking of, we're going to go see Santa next week. One of my very favorite things to do is myself sitting in Santa's lap. I did this last year, and you can see the like genuine smile on my face. I was the happiest boy ever sitting in Santa's lap. I am planning to do that again. And my son at the time was 12. He thought it was funny. My son at 13 will die of embarrassment. I am so excited about this. It will ruin his entire life.
You should go with Batman.
Oh my gosh. Could you imagine walking through the mall, totally dressed as Batman, and then walking up in Santa's workshop area and be like, "It's my turn for justice," and sit in his lap and be like, and what would you like, Santa, for Christmas? I want you to take out the Joker.
And then dress as Chris Chains.
Chris Chains, boy. Oh, hang on. That reminds me. I need to have some chains here. Real millionaires always wear chains. Don't y'all know that? Not one, but two at least. It's real millionaires wear at least 2 chains at all times. All right, there we go. Cool. Okay. Now that I've donned the right attire, let's learn from Art here. Is Santa real? All right, Art, what's the theory behind this?
So I started out trying to determine whether SQQ was an option for us to get into when TQQ wasn't an option for us. So we could be going short, because SQQ is the put, but the short, triple large short. And I spent a lot of time looking at videos and a lot of time back testing and trying to write a Pine script. And the biggest conclusion I got out of all that work I put into it was I need to take a Python class because Pine scripts are hard. Pine scripts are not easy. And Gemini and GPT are not very good at it. Claude works better on Pine scripts. So that's what I learned. So I pivoted and I wanted to see if the Santa Claus rally was real.
Cool. That's a great idea for backtest. I love that because you went into it, I assuming, with no biases, but like, does this actually work? What a great idea.
So I didn't know whether it worked or not, and I was doing a lot of research on it. And after I did my test, the tests, my algorithm for YouTube, I was getting all these Santa Claus rally YouTube things like crazy. So what I did was I decided I was going to backtest taking a trade the Monday after Thanksgiving and be out before the Friday before Christmas.
Gotcha.
Now, if Christmas landed on a New Year, if Christmas Eve landed on a Friday, I took it to Thursday. So there was a change in the plan. And I was trying to do 50 instances because that's what you said that we should do.
Right.
And the SPY, it's on the SPY, but the SPY is only 32 years old. So it started in 73. So
okay,
you can see where I started my data or my chart in the beginning, but then I landed up having to there was no data after or before 92.
That makes sense.
So the other thing was that the first 4 years of the SPY, the stock market was closed on Mondays in observance of Thanksgiving, which I had no idea. I didn't even know that was actually a thing. So
I didn't either.
If you notice, the first 4 ones are actually on the Tuesday after Thanksgiving. And so I took the SPY close and on the date after Thanksgiving, and then I took it the Friday or Thursday before Christmas. And I thought, okay, and that was my perception that that's exactly what the Santa Claus rally was. And only to find out later on that Santa Claus rally is the day after Christmas. And for New Year's. So, thank you to the algorithm on YouTube sending me all those YouTube videos on what the Santa Claus rally really was. So,
but you could call this the Art Rally. I like that.
So actually, what I'm going to call this is the Cyber Monday rally.
Let's go! I love it.
So it starts the Monday after Thanksgiving, so Cyber Monday, and then it ends before Christmas, right before Christmas. So you can see all the data in there, and at the very end, there's an expectancy of 2%, and you're in the trade for 17 days. The average is about 17 days, and it's 2%. So that's what I came up with was the Cyber Monday rally is real. So and Santa's real too. Cool. Santa's real too. But the Cyber Monday rally is a thing. So
that's really cool. I love it. I love your theory here. Also, I want to prove out our theory real quick. So let's do. Chris loves math, by the way. So let's do average win, average loss, win rate, and loss rate. Okay, so average win. We're gonna do average if range. This range here. Criteria is greater than 0. Average range is going to be the same range. Okay, just like that. I want to lock my cells. Okay, so the average win was 4.27% here. Cool. Now let's copy it down and let's change from greater than 0 to less than 0. The average loss was 2.68%. Okay, so far so good actually. Like if your average win is like, let's round and let's say that it's twice as big as your average loss. That's already a great strategy, right? That's already great. Win rate, so equals count if do I need ifs or if oh yeah, hang on, count if this is greater than 0, hang on, greater than 0, okay. All right, so that's the total, and then we do count equals divided by count. And then we just go here. That gives us a win rate of 68.75%. This is real, Art. You found something, dude. 2-to-1 risk to return with a win rate of 68%. Loss rate is easy AF. You ready? You go 1 minus that. Oh, snap. There we go. Okay, cool. So now we've got our average win, our average loss, our win rate, and our loss rate. Now let's calculate expectancy. Expectancy. So you can just do average win, okay, times win rate here, minus. Now we have to do a minus here because we already have a minus this times this should give us 2.10. And then watch this equals, this is average, total average, ready, equals average. Then we take everything here. The maths. Can you believe it? It took me 15.5 years to learn that. So all you got to do is take the average. Jeepers creepers. So there you go. I just calculated the expectancy here. This is actually a really brilliant strategy with a 68, nearly 70% win rate with a 2-to-1 risk to return. This is great, dude. This is seriously great. I love it. And I'm going to give you lots of kudos here. First off, you came up with the whole, I want to test something. That right there on its own is way better than, trust me, bro, there's always a rally between Cyber Monday and Christmas. Trust me, bro. Then you looked at it objectively and you said, okay, what happened between A and B? Okay. Pretty easy. Just calculate from one to the other. How many days in the trade kind of thing. Very cool. And then you did my little trick over there on expectancy, which we confirmed over here. And so you actually came out with, like I say, at the end of the day, the number of 2.10. Now let's take it one step further. Let's go outcome. So we know our expectancy, right? How many trades were taken? So if we just do a quick count, let's put this here, put count equals count. There we go. So there were 32 trades. So you take your 32 times your expectancy, gives you the actual outcome that you would have gotten over 32 trades, having taken that over and over and over. Pretty cool, right?
Yeah, that worked out.
Well done,
good.
dude.
So the other thing I found out was that I have to give mad kudos to Scott and Deep Thought on their ability to write Pine scripts, because I tell you what, man, that was very challenging, and it just wasn't coming out every time. I would try to back test and double check through trading view, and it wasn't the exact same thing that my Pine script was coming out with. I tried to do it manually. So kudos to those guys for being able to get those Pine scripts right.
Dude, I totally agree. This they've done incredible work to do all that. I couldn't believe how much work Scott put into everything. But I'm also really impressed with the amount of work that you put into it. So right there, how to calculate expectancy. I didn't say it. Trav said it. Is a pro tip. Pro tip. I didn't say it. Trav said it. Pro tip. Very cool. Well done. Well done. Golf claps all around. Golf claps all around. So, have I gone over everyone's plan at least once, except for Stocky Locky, who I don't want to go over his plan because it's dangerous? Have I gone over everybody's? Wait, I went over yours, didn't we?
No, we started with the the overall plan, but not the back test portion of it.
Okay. Let's go to Boston Mark's plan. Let's go. Hit me up, Mark.
Oh, so it was a little bit different from what I thought. This idea popped in my head, originally when we were looking at the plan ETF value zones. And when those went down, it's like, oh, you can just use Keltner channels. So I had those thrown up on my screen. And I noticed one of the stocks that I watch all the time bounce from the top to the bottom of the Keltner channels pretty regularly. And it's a pretty identifiable pattern. Like, it's pretty consistent. It just goes up, goes down, goes up, goes down, bounces all the way, in that small range. Doesn't have huge trends either there. If you look at the dollar amounts on the left side, it's not trading in a big range. I'm like, I wonder if I can milk this as it goes up and down. Just trade the bands. So that's what I originally started to do. And like Art, I found it's about 15 hours to discover that you suck at programming. And it doesn't work out. So there were a lot of different versions in here. I discovered the Keltner channel thing really wasn't the best way to do it. I looked at, does it touch it? Do the wicks touch it? Does it close above it? Does it close near it? That didn't work. So I started looking at it and trying to figure out another pattern. And what I decided on was the entry rules, which are a little bit down below. Whereas I look for a 5-10 cross on the way up. So that kind of tells me, okay, trend reversed. Now we're going in the right way. And I just made the exit off a really simple, we close below the 5-day EMA. I couldn't find a way to find like a solid reversal of the trend yet, which is going to be like my next iteration of it to try to get that little extra out of it. So super simple. And, didn't really need an emergency exit or anything like that because the 5 days obviously really tight.
Really tight.
But it works really well in this case on this stock, which is what I looked for. I didn't try to apply this all the way around. I just looked at this particular stock, because I like the way it moved. So I'm like, okay, how can I make this work? And like I said, it doesn't trade a lot. So if you go to the 10-day EMAs, as an exit point, you never make any money, because the way the crossovers work, it just doesn't move enough for you to make anything to make it worth your while.
Interesting.
So what I ended up on for now is I looked at a couple of different ranges. I looked at some more. So I went all the way out to 2,000, which is as far as TradingView would let me. So that gave me 264 trades. And the thing that stood out to me is it's only a 42% win rate. But some of the wins are decent. Some of the largest win was 40%, and the largest loss was only just under 11. And your trade durations are pretty short. Average was 10, or average was 7. Your average win was 10, and your average loss was 4. So these are pretty quick occurrences. And everything was below the buy and hold return, of course, but you're not in the market that much. And on the fear side that I'm still kind of dealing with, your max drawdown was only 9%. And that ended up with a 1.21% expectancy.
There you go.
So not bad, but not great. Some things to improve upon, for sure.
Right. If I were giving any feedback on this, I would actually say this is really, really, really tight. I mean, it's so tight, you're not even going to notice when things are happening, PBR. And I'm not trying to disparage the plan at all. What I'm trying to say is because it does happen so quickly, there's going to be a lot of chop in this trade, a lot of chop. And that's probably, oh, hang on. Which one was yours? Yeah, that's probably what you're coming across right here. So if you widened some numbers out, it would actually probably help your win rate. However, I don't know what I'm talking about. I'm just talking out my backside, right? The data is what matters. There's no trust me, bro. Trust me, bro, Mark. If you widened out all the numbers on there, bro, you would totally have more money, bro. But you could come back and you could be like, well, actually, Chris Chains, I'm Mark Chains, and I know that using this is actually the highest expectancy based on what I've tested. That's really important, dude. So you got to be able to defend it to yourself, right? I know that this is the best thing that I can come up with.
So what's interesting about that comment is if you look at the other two columns that are in there for the data that goes for the past year and then 2023, the win rates actually improve, but your averages go down. It's a smaller sample size. There's not a lot of trades.
Sure.
But I thought that kind of stood out a little bit too. And
well, that can mean that it's favorable environment for that stock, right? It's, oh man, hang on. You guys give me just a moment here. I actually have, this is worth sharing. You brought this up. I'm so glad you brought this up. 2 seconds. I need to grab something. Hang on, commercial break.
Heading the right way. Now get on it and buy stock.
21 seconds. I'm pretty proud of myself. Listen, 21 seconds is my average. No, I'm saying. All right. So I found this story in this book absolutely fascinating. And it totally ties into what you're talking about right here, right? Let's say that we have 400,000 men and women engaged in a coin flipping contest. Okay? A coin flipping you know what's going to happen in a coin flipping contest. So first, 200,000 people think they're winners because it just happened to land on heads or whatever, right? They flip again. Another 100,000 people are winners. And they're like, oh man, I'm so good. How's it going, right? Then they flip again. And those 100,000, 50,000 have won again. And on the fourth game, they're down to 25,000 that have won 4 in a row. And on the fifth game, 12,500 have won 5 times in a row. And so now they're looking at each other and they're starting to give news interviews. They're starting to go out on YouTube channels, right? I'm just trying to make this for a modern audience. They're going on a podcast talking about their incredible success. And then, you know, they flip it a couple more times. And the people that are left after 15 games are regarded as the greatest coin flippers in history. They're the ones who never lose, and they have their biographies written, right? And so I think that is a really solid point about how you can have 11 trades that actually show tremendous results better than everything else. But when you use 264 trades, it's not quite the same. So where I'm going with that is actually the bigger sample size. This is going to be way more relevant to you. Way more relevant to you. Even though this is more recent, the frequency is going to be more relevant. Does that make sense? Okay.
100%. That's actually one of the comments that I put just under that table.
No, did you? I know you're a smart dude, guy. All right, go for it.
So, no, I mean, it was just, so my big takeaway is kind of like what you mentioned. So PBR in this case, it's highly cyclical, but it also doesn't swing enough to capture like big games. So that using like a 10 EMA strategy or anything like that, like you're mentioning, doesn't work on this stock. It needs to work on something that has a bigger swing in its price moving. Because in this case, you're only talking $2 to $3. And by the time that crossover happens, there's nothing left for you to grab. You know, like you're only grabbing like the condiments and you're not getting any of the meat or anything like that. So
yeah,
it doesn't work on this particular one. It might work on something like Chevron or Exxon or another energy stock that shows similar cyclical movement. That's also something to look at, you know, in the meantime. It also only considers the write-up, you know, and I get killed in the chop. Like when it's going sideways, it doesn't work. So I need to find a way to kind of maximize some of the trends a little bit more if I'm going to stay with this strategy to kind of really get the extra out of it.
It does seem to be a very choppy stock too. But with that is opportunity. And I think that that's what you identified, is that this is a choppy stock, but every time it crashes up, I can take advantage of that over and over and over and over. So actually, I love that idea, right? Finding a stock that has movement.
It crashes up and it crashes down a lot. So it's like, okay, well, how can we capitalize on that? Like it doesn't have solid trends for a long period of time, one direction or another. Like it's just kind of like, can I surf this wave as it goes up and down a little bit, you know, and just grab a little bit here and there? And is it worthwhile to do that? Or is it worthwhile to chase something with the bigger trends, you know, or maybe this is an option, you know, for something else. And then down on the bottom, you know, like my last comment there is like, it clearly shows how small sample size looks vastly different than the larger. and also how a lower win rate under 50% can still result in a better overall return.
Yeah.
You know, so
Dude, great observation. I'm glad you came to that as well. Because, you know, a lot of people get suckered into, wait a minute, these 11 times this same thing happened over and over, and it's the most recent 11 times. So therefore, it has to be the best and it will only continue in the future, right? Trust me, bro, it's only up from here. And then that's where they get, you know, totally hosed. So well done, Mark. I like this. This is cool. And I'm most proud of you for this right here. You understood the sample size does make a difference, right? We're back in math class in high school and college, and we're applying it to the stock market. Okay. There and it's so funny because it's the exact opposite of all the other YouTubers out there, because we actually want to make money from trading, right? And so you guys are doing a fantastic job here. So congratulations to you, Mark. I think you did a great job. Golf claps all around, my friend. Golf claps all around. All right, Mr. Skinny Buff Guy William, we've not done your strategy. I swear that we did the other day.
Well, I rambled on for like 20 minutes about different strategies to do a trading plan, but no results yet.
Okay.
Yeah.
Is this it?
Yeah, that's it.
Okay, got it.
So I did a couple of different things, and I'll try to move through these kind of quick. So I looked at the SPY and the QQQs on the on a strategy of just a simple EMA crossover. So I actually chose a 9 and 21 as my short and midterm ranges. And so I went back to the beginning of 2020 and ran this through this week, 12/16 close. And basically the criteria are when the 9-day EMA crossed above the 21-day, it's an entry. And when the 9 crosses back below the 21, it's an exit. Very simple. I actually was, I started doing a lot of back testing with a little bit more entry rules. And I just found it's, when you're going through the charts manually, it's a lot. So I wanted to do something simple for my first test and actually try to get as accurate a data as I could. So for the SPY, it resulted in 32 trades. I'm sorry, 21 trades, 11 wins and 10 losses, which was a win percentage of 52. And then it resulted in the largest win of 18.6, and the largest loss was a quarter of that size. So I thought that was interesting. And the average loss was significantly lower than the average win at 1.7 compared to 8.7%, which gave us an expectancy of 3.7. Now, we've been pretty bullish for a while now, so I wanted to compare that to the buy and hold, of what buy and hold would have done with the overall cumulative return going back to the beginning of 2020. Mm-hmm. And we underperformed the market. And I did not calculate out the exposure, the number of days that we were in the trades, which would have been some nice relevant information probably to see what our capital efficiency is. But we got fairly close, and we were definitely in there a significantly lower number of days. So I thought that was interesting.
I think that is interesting. And it does reinforce the point that you don't have to be in the market all the time to get nearly the same returns as the market, meaning you're going to skip all the big old nasty down moves completely because it won't be there with a 9 and 21 crossover. It just won't be there. You will not be participating in a down move. And then on top of that, right, over 5 years, you're only taking 21 trades. So you're taking, you know, what would that be? 4 trades a year? Mm-hmm. Dude, imagine how much of a lifestyle you can create for 4 trades a year, and yet you still get similar returns to an incredible bull market. Mm-hmm. Right? Lifestyle design's a real thing. And then on top of this, let's be realistic here. If you're not in, you could be trading something else. That capital efficiency point. So yeah, this is actually really good. I like it. It's simple, and that's okay. You don't have to have anything complex. Not at all. The simple could work the best. Tell me about Qs.
Yeah, so similar thing here. Only 24 trades in that 5-year period, and it was a 50-50 win-loss percentage. Again, our largest win this time was 6.5 times bigger than the largest loss. And one of the things I do like about this EMA cross strategy, which, Chris, I learned this from you, really is when we do have a bear market, you're out of it because the EMAs have crossed. So you can see that with the largest loss and the largest win. You've really reduced your risk. I like that. I'm willing to give up some gains to reduce, you know, how much you could lose. Average loss 3.5%, average win 11.1. So, I mean, over 3 times bigger again. Expectancy on this one, 3.8% per trade. And again, we underperform when we actually do look at what the cumulative return was compared to a buy and hold strategy. But again, you have significantly less exposure. And also, I feel like, again, you're just minimizing that risk, and why not do that? And when you came up with Plan M, we're using the Qs and the SPY, but trading the triple leveraged. So if you really want to try to outperform the market, even with the triple Q strategy, if your largest QQQ loss was 5.1, I didn't actually put the numbers on here, but that would be a 15% drawdown potentially.
Mm-hmm.
And you might actually be seeing a cumulative return of 300 and some percent compared to a 195 for a buy and hold. So yeah, I didn't put it there, but in my head, I'm thinking some of these things, like there's a lot of different ways you could go with that data.
Right.
And that's only 5 years, but it should be enough time. We've definitely seen bear markets in the last 5 years. We've seen bull runs. So,
well, you can add these two together, right? You've got 24 here and 21 there. You're close to 50 between those two, right? And 50, so I got that from Steve Burns. 50 is at least the minimum that you need. So you're knocking on that door right there. But you've got a lot of really very, very salient points here. Largest win of 33%. You're not going to have a loss anywhere close to that on this type of strategy. You're just not. Your average loss, 3.5%. Your largest loss was 5%. Give me a good gravy on that, right? Your average win is 3 times higher than your average loss with a 50% win rate. That is a huge, huge expectancy. I know it doesn't seem like much. It's only 3.8%. No. If you think about it this way, if every time you flipped a quarter, you made $11 average win, and every time you flipped a quarter and you landed on tails, you lost $3.50. How many times would you flip that quarter?
As many as I could.
Infinity times. I'd be flipping it in my sleep. I would be paying people in different parts of the country to continue to flip it all 24 hours a day. Because you understand a 50-50 win rate, but a 3-to-1 risk to return is undeniably huge. And yet it comes out to what seems small at 3.8%.
Yeah, when I was doing my calculations, in my head, I'm dividing. I'm like 11.1 and 3.5 for the average win and loss. How am I only at 3.8 expectancy? You're thinking, even if you're in the middle there, you should be somewhere around 7. Wait a minute. Oh, that's because a win and a loss is 2 trades. So you're taking the average and dividing. Anyway,
let's double check your math here.
Yeah,
did I close that son of a B? Okay, hang on. Average win, average loss, win rate, loss, rate. There we go. Oh yeah, that was Art's. I already closed. My bad. I should have saved that. All right, average win, 11.1%. Average loss, 3.5%. Win rate is 50%. Loss rate is obviously 1 minus this. So expectancy is average win. Okay, average win. I got to equals average win times win rate. Okay, minus, this is a positive number here, so I don't have to make it a negative. This times this gets you to 3.8%. Yeah, you nailed it on the math, which doesn't seem like much, does it? 3.8%, meh. But when you put it in context of coin flipping, oh, wait a minute. That's a big deal. Your goal when you come up with expectancy is positive. 0.01 is a winning strategy. You do that enough times, you have masters of the universe money. I mean, legitimately, that is all you need. But when you come up with something that's 38,000 times higher than that, you don't have to flip it 1,000,000 times to get there. You can take it a lot less times and still get masters of the universe money. So this is great. This is great. You should be very proud of this.
Thank you. I do want to look at the next page. There's one more thing. So I did a quick Tesla back test, and I went back to the beginning of 2022 so I could get 4 years of earnings. So my goal here was, again, to take a simple strategy, 10 over 20 EMA, and then the exit is the 20 crossing back on the 10. And in this case, I did it just straight up. And then if you scroll down just a little bit, I'm going to have you go down once, and then I'm going to have you come back. I added a parameter to exit the day of earnings. So we're going to close at the close of the candle on earnings date, and we are not allowed to re-enter for 3 days.
Ooh.
I want to see if there's a difference in expectancy on that.
I wonder if there's a difference in expectancy on that. Okay, walk me through it.
I will tell you, I went all the way back to 2020, but I couldn't get I actually wrote a Pine script for this with Claude AI, which, by the way, Deep Thought hooked me up and told me don't even waste your time with ChatGPT and Gemini. Claude AI is light years ahead as far as helping you write a decent code. All right, so anyway, the Tesla trades, I got 21 trades, and I actually had a very poor win percentage, only 8 wins out of 21 for a total percentage of 38. My max loss was 13.8, but my max win was 49.8. And the average win was 19.8 compared to 6.3 for the average loss, which resulted in an expectancy, again, of 3.62%, which actually, this plan came out significantly better on your cumulative return with those trades than a buy and hold would have.
Mm-hmm.
Tesla's extremely volatile, so you get a lot of opportunities to get out of the way on the downswing and then just try to ride up the upswing. I was pretty amazed by that because we underperformed on the SPY and on the QQQ, and I did use a 921 instead of a 1020 for the 2 parameters for the EMAs. But to get a triple return on Tesla alone compared to like a SPY or a QQQ, I thought that was interesting.
That is interesting.
Yeah.
And you're still coming up with a super high expectancy here. So that's great.
Mm-hmm.
Okay, so you added in one more criteria, which again, talking about having an idea, testing it, seeing the result. Let me tweak that idea, test it, see what the different result is. That is how you backtest. That is exactly how you backtest. Let's keep going. Let's see.
Yeah. So this one actually resulted in 26 trades. So I think we had 21 without earnings. And this one, because of the earnings exits, it created extra trades. So we had 26. Again, we still had a fairly low win percentage at 38.5. So on this one, the largest win was 61.7%. I think above it was 49. The largest loss was 13.8. So we're just a little under 5x there for our biggest win compared to our biggest loss. And the average win, again, almost triple the size. So an average win of 21.4 per trade compared to an average loss of 7 gave us an expectancy of 396. So very close, but a little bit better than not taking earnings into account. But it actually made a bigger difference, even though it was only fractions of a percent on the expectancy. Because of the extra trades, we ended up getting a cumulative return of 86.5% compared to 28% for the buy and hold.
Mm-hmm. So you used cumulative return here is basically the outcome formula, where you're taking the expectancy times number of trades?
Correct.
Okay, gotcha. Dude, that's awesome, right? And another reason why you proved to yourself, trading earnings may not be the best idea. A lot of people want to trade earnings. They want that excitement. It's like walking in the casino and they're like, put it all in black, baby, let's go. When you don't need the risk. You literally don't have to take the risk at all. You can just step out, be like, I'm going to wait outside real quick. Okay, I'm back. Like, it actually can be like that. I don't understand people who obsess over a stock. They hold it all the way down, hold it through the worst earnings ever, and they're like, but it's a great stock. It's an amazing company. You're not getting paid by anything other than the price going up. And here, William, the skinniest, buffest guy that I know, just mathematically proved a very high expectancy following a really simple plan, a 10 and 20 cross, and not trading through earnings. Pretty cool, right? Well done, dude. Well done. Was there more to this?
The rest is just the spreadsheets. And actually, my cumulative return I actually came up with because I started with a theoretical $10,000. We don't have to look at all the numbers, but a $10,000 account to start with.
Yeah,
and if you do look at the very beginning, it'll only buy the number of even number of shares that you can get for up to 10,000. So actually, I think that my cumulative return comes back a little bit lower than what it would be if you could actually do fractional shares. So again, here, look, you entered with 32, which was only $9,825. You didn't get to utilize that whole 10 grand. So that actually might not come back. So if anybody's actually looking at that and trying to multiply 3.96 times 26 trades, and they're like, wait, that's not 85%. That's why I think.
I actually am really glad that you pulled this out. Now, this is one step further in backtesting. And so, for example, this summer working with Scott would send me these numbers. And he'd be like, well, this is awesome, isn't it? And I'd say, send me the download. I want to look at it. And then when you're actually looking at the trades, you may spot things that you wouldn't have seen in the data as a whole. On the summary numbers, you won't see the loss. In fact, best story I can give of this, Scott sent me numbers that looked astronomical. They were amazing. I said, cool, send me the numbers. And I'm looking through this, And what I like to do is like this, where I highlight greens and reds based on like the value. It makes it a lot easier as I'm going through it. I'm scrolling, and I see a huge swath of red. I'm talking 120 losing trades in a row. 120 losing trades in a row. And I was like, what the hell, Scott? What is this? And he's like, well, follow the plan we talked about. And I'm like, yeah, I know. But clearly there's something here that we didn't consider. And so we went back, and it was taking long positions in the midst of a downtrend in the SPY. The market was bearish, yet taking bullish positions. And I was like, well, no, duh, it lost on everything. The whole market's going against you. So then, of course, we modified the rules and came out with a different number. But that you wouldn't have seen just looking at the numbers. It actually took looking at the positions to get to that point. And what tipped me off to that was looking at your position size here was over close to 10,000, over 10,000, under. And I'm like, oh, wait a minute. He probably hit a losing streak right here. Nothing wrong with losing streaks. But losing streaks can help identify if something's not working right? So maybe if there was a losing streak here, you could then make a correlation. Man, this is what Chris loves to do. You can make a correlation. Okay, what's going on in the sector? What's going on in the market at that point? Is there something bigger at play than just Tesla itself? And then you can come back and say, oh, you know what? If I add then this criteria, when the market has a buy signal, when the market's trending higher, and then I add that in, oh, wait a minute, that resolves itself. My win rate goes higher. My outcome goes way higher. Does that make sense? And you won't see that on the bottom line numbers.
And you're right too, because actually, if you go back to the chart 2022, not this chart, on the actual stock chart, on the, if you wanted to, you could pull up 2022 for Tesla. Tesla lost 67% or 70% of value.
6-7.
So it makes sense that if we're trying to trade that year, that we were consistently losing. I think that was like 4 or 5 losses right in a row there. Yeah, that doesn't look like you'd really want to be in that.
Yeah, that's a tough market to trade in 2022, isn't it?
Mm-hmm.
But you don't have to. You don't have to. You just get out of the way. So, William, this is great, and I really appreciate you sending over the spreadsheet so we can go off on that tangent. So, well done. Golf claps all around. Outstanding work. Now I can see even Stocky Locky's clapping in the dark. That's probably a good song, Clapping in the Dark. There is a great song about trading in the dark. I'm gonna light that one up for on our way out of here. Thank you, Rick, for that. Hold tight. Trading in the dark. By the way, I still listen to Rick's songs as a playlist when I'm at the gym. Trading in the dark. Got it. It's more of a Halloween vibe, but it works. So did we go over everyone's plan except for Stocky Locky? I don't expect you to worry about it, my friend. I know you got life going on over there. You're all good. Is there anybody I missed? No? Perfect. Oh, Charlotte, what's on your mind?
I just wondered if we could say a thank you to DT. He helped so many of us.
No. Thanks for asking that.
He was amazing.
Yeah, of course. And he is great. I don't know about you guys, but I love smart people. They help me make lots and lots and lots of money, and helping you make lots of money as well. This is great. Outstanding work from all of y'all. I'm really, really impressed. Right now, the goal here is to come up with strategies you can do on your own. What we talked about today, and going back to what we talked about with Shane, if you don't like your strategy, you're not going to trade it, which is why I'm not going to shove mine down your throat. I'm not going to say, this is the Wall Street protocol. No, all I'm going to say is that this is the principles that always work. You get to use those principles to find what works with your personality. Then you can find incredible success in the market. So we have 2 weeks off. No Ovtlyr University, no class until January 6th of 2026. The homework, though.
Yeah.
The homework. I know you guys have got some trading books. Read something over the break and bring me back something. Bring me back an insight that you found. Listen, you could read you could read Where Are the Customer's Yachts, and you could come back and be like, hey, I heard about that coin flipping story. You don't have to read this. I don't care what you read. Find something interesting, read it over the break while you got some time, and let me know what you find. I think that'd be really cool. So, everybody good? Everybody understand the assignment? Too easy. Too easy. You guys are the best. I'm really proud of you. What we're doing over here is changing lives, not just yours, but everybody watching. You're in the process of learning how to create generational wealth, and I am super grateful to be a part of this with you. I hope you all have a fantastic holiday season. Thank you all for being a part of Outlier University, and I'll see you back here in class on January 6th. Have a great long holiday break. We'll talk soon.